Here I'm going to list out the various types of accounts that are classified as, or will be classified as, assets, liabilities, revenues, and expenses. I figured I'd just clean it up a little bit with presenting the accounting equation again, because up here from the previous video, I explained what the double entry system is by using the accounting equation, because I think it was a best, I want to say, tool to use in order to demonstrate what the double entry system is used and how it is used. Okay, so I scroll back down here to the refined accounting equation. Assets equals liabilities plus equity. And you can see here, there's something at the top or above assets, liabilities, and equity. You see the plus sign and the minus sign, same with the liabilities plus equity, but opposite. Now, right above these plus and minus signs, you see DR and CR. Okay, well, CR stands for credit, DR stands for debit. Now, I am aware that the word debit doesn't have an R in it. Debit and credit came back in the, I want to say, in the days where English wasn't around. So DR, debit, really was, I want to say it actually had an R in it. I want to say in Latin, the word debit. So the word debit comes from, I don't want to pronounce it, but it's DEB as in boy, ERE, something like that. But it has an E in it, and which means to owe. Okay. So that's where the DR comes from, debit. Because even I was wondering, what does DR have to do with debit, or how is it relatable? Okay. So that's what it is. Okay, so DR stands for debit, CR stands for credit. So as you can see here, to increase a balance in an asset account, you will debit it. That's what the plus sign indicates. And you do the opposite on the credit side. Okay, you will credit it to decrease it, which indicates that minus sign. So liabilities plus equity is like a mirror that's looking at assets. Okay, it's a mirror that's looking at the assets. Because the debit and credits are opposite, so it's a reflection. All right. Also, it does show that the economic resources funding source, where is it coming from? How are you funding the resources? So it just shows that cycle. All right. That evolution cycle. So again, liabilities, to increase the balance in the liability account, you will credit it. To decrease it, you will debit it. Equity. Well, equity is made up of four components or four accounts. That's owner capital, owner withdrawals, revenues, and expenses. So a normal balance in a capital account should have a credit balance. All right. So that's your credit right there, DRCR. Owner withdrawals is the opposite. A normal balance in an owner's withdrawals account is a debit balance. Revenues is the opposite. A normal balance in a revenue account, credit balance. And then expenses, the opposite. A normal balance in expense account, it's a debit balance. All right. So, like I said in the previous video, normally the owner capital account should be greater than the owner withdrawal account. And normally the revenue accounts should be greater than the expense accounts in total, which this means that a normal balance in the equity section should be a credit balance. So again, assets equals liabilities. It's a mirror. It's like they're looking at each other in the mirror. All right. So hopefully that helps when it comes to remembering, or at least understanding, why certain accounts are debited to increase or decrease the balance in that account, and why are other accounts debited or credited to do the same thing. All right. So type of accounts. Assets, we're going to start there. So assets, we know, have value. Okay. These are pretty much resources, whether it's tangible or intangible, that are acquired with the expectation of receiving future economic benefits from those resources. Okay. That's assets. Okay. So common asset accounts, which is what you're going to see in your textbook. You have cash. That's number one. Then you have accounts receivable. What is accounts receivable? Okay. Accounts receivables are credit sales. Credit sales. So if you purchase something on credit, that's a credit sale that occurred. So the other company that you bought something from will have to record the purchase as a credit sale. So it'll be sales revenue, but it's credit. They haven't received the cash yet. So accounts receivable is an asset, because if somebody, let's just say, for example, you perform services to a client and you sent them off an invoice. So you just solely sending an invoice to that client means that you didn't receive cash yet for your services that you performed. Instead, you sent an invoice, which means that you have an IOU, or you have an IOU sitting on your account from that customer, because that customer needs to pay you in cash. So that IOU is an asset, which is a receivable. You're due that money that is owed from that customer for performing services to that customer or client. All right. So then we have inventory. Inventory is where you purchase or acquire items with the expectation of selling those items for a profit. That's inventory. Then you have prepaid expenses. Okay. Prepaid expenses are expenses that you're paying in advance to use it in the future. So when you make that initial payment in advance to use what you paid for in advance in the future, that's initially going to be reported as an asset. All right. Once you use up what you purchased in advance, then the costs will get transferred from the asset account into the expense account. So that will make more sense later on. But prepaid expenses, okay? So examples of prepaid expenses are rent, insurance, supplies, and yes, depreciation is a form of prepaid expense. Okay, depreciation, it is a non-cash thing, which will make more sense later. All right, prepaid expenses. Okay, what else? Pretty much list out a good amount of assets here. And then we have one thing I want to not leave off is property, plant, and equipment. Yeah, property. There we go. Can't spell. Property, plant, and equipment. Okay, so if you have a vehicle, you have machinery, equipment, something like that that you use for business, that's an asset. Okay. Liabilities, what you owe. Okay. Accounts payable, that's a liability. That's the opposite of accounts receivable. So accounts payable is what you owe. Anything that you owe within a short time span. It can be 30 days, 60 days, 90 days. I mean, it even could be a year, at least a year, but it's pretty much something that you can, I want to say, liquidate within a short time span. All right, accounts payable. So many items can go into that account. Then you have what is called unearned revenue. Okay, this is pretty much the opposite of the prepaid expenses that you have here. Okay, prepaid expenses for assets, unearned revenue underneath liabilities. So on the flip side of this, if you are, let's just say, the landlord, so you own property, and then a tenant paid you money rent out a facility for 3 months. We'll say it's for $6,000. Well, initially that $6,000 of cash is going to be recorded as an asset, but the offset to that is going to be a liability called unearned revenue. And that's because you have not earned the cash that you received in advance yet. You haven't earned it yet because the person has to use the facility first in order for you to earn that cash that you received in advance. Okay, so this means that once the person uses the facilities, as time goes on, you'll be able to now transfer what is recorded in the unearned revenue account into an actual revenue account, because you earn that money because the facility is being used. All right. So it's the opposite of prepaid expenses. Okay. And it's a lot of different payable accounts. Like you got bonds payable. Okay. Bonds payable. Bonds is pretty complex. It's a complex accounting, I want to say, topic. So that's something that's going to be covered in ACC 112, another accounting class. Okay, then you have notes payable. Okay, going back up here to the bond payable. Bonds are usually issued by the government, but corporations can issue bonds as well. There are such, I want to say things that I want to say are classified as corporate bonds. So corporate bonds, governmental bonds, it's all bonds. Notes payable. Notes payable is when you go to the bank and take out a loan. Okay, notes payable comes from the bank. Oh, how can I miss this? Accrued liabilities or expenses. Accrued expenses or liabilities. All right. Now, a lot of things can go into the accrued expenses account. You know, you can have salaries and wages that go in there if your company is small and you don't want to separate out the salaries and wage accounts. A lot of things can go underneath accrued expenses. All right. So now we get to equity. Again, equity is made up of 4 components in the accounting equation. Now, the owner capital and owner withdrawal accounts, though, these are both actual equity, quote unquote, equity accounts. The revenues and expenses, well, they're just revenues and expense accounts. Okay. These 2 accounts go into the income statement. Now, revenues, you have anything that's revenue related, that's actual revenues, not unearned revenue, but actual revenues. So revenues, we have sales revenue. And that's when you sell items, goods, products. It looks like my computer's giving up. This is not me misspelling revenues. All right, then you have service revenue, and this is when you actually are not selling items or products. Instead, you're selling services. And then you have rent revenue. It's another type of revenue account. This is when you are a landlord and you are in the business of renting your properties out. And so whatever money you get from the tenants is considered rent revenue. And interest revenue, I'll just leave it off with that. Interest revenue is when you are somebody that lent money to somebody and you pretty much are going to want to get paid that money back, which is the principal balance plus interest. That interest is going to be revenue to you. All right. Then we move down to the last one, expenses. Expenses, we got cost of goods sold. Cost of goods sold. That's when you're selling an item and you're going to not only recognize the sale revenue of that item, but you're going to recognize the expense that went along with generating that revenue. So cost of goods sold is an expense account. Then we got what else? Salaries and wage expense. Then we have rent expense. It's a lot of expense accounts. We have utilities expense. What else? We have interest expense. And I'm going to put the last one here, depreciation expense. Okay. So these are, again, it's not a comprehensive list of all of these accounts. This is just accounts that you will normally see in a textbook and that are normally used. So let me zoom out so you can get the bigger picture here. Yes. All right. And so what I'm going to do in the next video is now use the double entry system, which is the recording tool that is used to debit and credit specific accounts to increase the balance in those specific accounts, and go over just pretty much do a demonstration of the dual effect that each transaction has. And you'll see the movements of these debits and credits, what accounts is going to, and it pretty much will paint a clearer picture of the story about a company's flow of economic resources.